Hi, welcome. It's Mary Ellen McGonigal, Senior Managing Director of Stocks here at Simpler Trading with your weekly Edge show for Saturday, January 8th. Today, we are going to go ahead and take a look at some of the more impactful news. It was a very active week last week, a lot in the way of rotation taking place very actively. And then from there, we are going to take a look at how the markets stand into Friday's close with an eye toward what to anticipate going forward. Last up, we will take a viewer question of the week, and it's all about earnings season that will begin next week with Q4 earnings. Major bank stocks due to release their results, which in turn will make way for many other companies in the coming weeks. So let's take a look at some of that news, and certainly one of the most impactful news items was the fact that the Federal Reserve's notes from their December meeting talked about the desire to speed up their increase in interest rates, and also cited was the fact that inflation had really risen quite a bit faster than the Federal Reserve had anticipated. This news in turn had a profound effect on the markets, and we will get into that. That was on Wednesday. And then jobless and employment numbers were rather mixed. We did see jobless claims rise a bit, and then new job creations falter. So a lot of that is potentially related to the Omicron variant in various states as it's being impacted there. But overall, the mixed results really sent kind of an uncertain confusion throughout the markets, so that we did end the week on a rather weak note. So we will get into that. And then again, talking about the Federal Reserve's comments, in turn, the news did cause a spike in the yield on the 10-year Treasury. So we can see on this particular chart that the 10-year Treasury yield closed at 1.77, and a lot of investors were keeping an eye on that level back here, that peak in price back here in April. We did break above that, and again, rising interest rates had a big impact on the markets, and we will get into that because at this point in time, interest rates do appear to be headed higher. We've broken above this prior high here, and then we have outside momentum indicators that are heading upward, so we can anticipate continued moves in select areas of the market as interest rates potentially continue to rise. Let's take a look at the markets and see where did we close for the week and what we can anticipate potentially going forward. And here we are with a daily price chart of the S&P 500 index, and the index was down 1.6%, and that was the worst beginning or first week performance of the S&P going back to 2016, which was a time when China had a flash crash, which in turn impacted the US markets. Not the best way to start the year. Let's take a look at how we closed. The S&P did find support at this red 50-day simple moving average, so that's constructive. We can see, however, that the outside momentum indicators, the RSI, dipped into negative territory here, and the stochastics are just now poised to potentially turn negative. If they break below that 50, that would be negative. As far as looking for possible areas of downside support, we are going to pay attention to these recent lows here on the S&P 500, with 45.31 being this most recent low, with the index closing today at 46.91. So that is your next area of downside support. The fact that the index was able to recover back above that 50-day simple moving average is certainly constructive. Let's take a quick look at the Nasdaq, and this was the worst performing of the broader market indexes, down 4.3%, and this is all about that spike in interest rates and the fact that high growth and in particular technology stocks tend to underperform as interest rates are rising. So we can see the price action this week did push the Nasdaq below each of its key simple moving averages, the RSI, relative strength indicator, and stochastic, both momentum indicators ending in negative territory. Your next area of downside support is very close. For the Nasdaq, it's 14,860. And we did close at 14,935. So we will be looking for the index to find support there. If not, the next area of support is this 200-day simple moving average at 14,681. So from here, let's go ahead and take a look at the underlying sectors within the broader S&P index. And what we are viewing here is a 2-month daily price chart of those 11 sectors. I've gone ahead and added a relative strength indicator, sorted it in descending order. So up in this upper quartile are your stronger areas currently in the markets. Down here, weaker areas that you'll want to underweight given the current dynamics. So first up, we can see energy up here in the forefront, up 10.5%. This is an area that does respond very favorably to a higher interest rate environment, as well as higher inflation, which is currently in place. So lots of oil-related stocks in nice confirmed uptrends. From here, I'll share with you another area that responds to interest rates, and that is financials. Our next segment, I'll share a specific area, but financials far outpaced the markets as well with a 5.4% gain. Gap up earlier in the week into a nice confirmed uptrend with your outside momentum indicators in positive territory. From here, let's take a look at some of the areas that are in negative territory. We talked about technology, down again this week, 4.6%, has broken below this 50-day simple moving average. High volume on the sell-off with the outside momentum indicators now trending downward and the RSI in negative territory. And we'll dig into those sub-industry groupings up here next as we take a look at some of the areas that are certainly relevant as it relates to the markets. We have each of the broader market indices. We also have software, the yield on that 10-year, semiconductors, oil prices, and so on. Again, a 2-month daily price chart view with that RSI. Let's take a look up here again in this top performing area. These are bank stocks. KRE is the ETF for the regional banking index, and that was up 9% this week. That spike in interest rates has been very bullish for bank stocks. They do thrive in a rising interest rate environment as their profit margins expand on their lending activity. So very vibrant area of the markets at this point in time. We did see an uptick in crude oil prices back up above this $80 level. That's a secondary reason for that nice 10.5% advance in energy stocks. And then from here, we want to pay attention to some of those weaker areas. And first up here are semiconductor stocks, down 4% on the week. And they had been holding up quite well, hit a new high earlier in the week, but later in the week as interest rates rose, we can see a drop below this 50-day simple moving average with that RSI now turning negative. Another area in technology is software stocks continuing to deteriorate, another area highly sensitive to interest rates. The IGV ETF for software stocks was down 8.6%, breaking below this 200-day simple moving average. Outside momentum indicators quite negative. So we can see within tech those areas that are most heavily being impacted. Biotech stocks, tough week here as well, down 8%. This is a very risky area, so the decline in biotechs, as well as one other area that I will share with you. These are areas that you want to make sure you're not overweighted in. Small cap stocks, this is the Russell 2000 index, down only 3%. And I say that relatively, but definitely in a downtrend. Both biotechs and small caps are risk on areas, and they are not being favored during this current rotation that is taking place in the broader markets. So from here, let's go ahead and talk about earnings season, which is due to start next week. I will share with you two companies that reported this week to help give a feel for what we can potentially anticipate as we enter into Q4 earnings season. First up is FC, ticker symbol for Franklin Covey. The company came out with their earnings on Friday, and the numbers were really quite bullish. The company reported 550% year-over-year earnings growth, 800% above estimates. And this price action today does not bear with the broader markets we're seeing as far as selling pressure. The stock was up 11%, and we can see a nice gap up on heavy volume. The stock is a hair away from a nice 2-month base breakout, the RSI positive trending upward, and your moving average convergence divergence, your MACD momentum indicator, trending upward in positive territory. So very constructive looking, giving us the sense that if stocks that are not in those weaker areas of the market can come in with numbers ahead of estimates, we could conceivably see nice bullish price action in response. Another company that did report today tells the other potential side of the story going into earnings season. This is AEHR, a semiconductor company, and the stock was down 21% today despite reporting earnings and sales that were ahead of estimates. And a lot of this deterioration in selling was due to the fact that the company is at a super high multiple. They are trading at 410, their PE, well above the average of the S&P 500. In addition, the stock is up over 600% year to date. So selling on the news. Last up is the fact that it is a semiconductor stock in that industry group that, as we noted earlier, is coming under distribution. So two sides of the story here as it relates to earnings. Even though this company reported above estimates, their high multiple and high year-to-date performance has investors taking profits, which in turn is putting the momentum dynamics negative as compared to a company in an otherwise strong industry group reporting strong numbers having positive reaction. That's it for this week. Have a great weekend. Look forward to seeing you here next Saturday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.